evening, ladies and gentlemen. Welcome back to Walk the Block, where we're navigating digital finance all together. I am your host from a slightly different place today, Zenith. Happy to be with all of you guys here tonight. We got a bit of the crew back again. So, Tracker, good to see you, my friend. How you doing?
Doing well, doing well. Some things did manifest like we thought they were going to manifest so far. They're kind of unfolding kind of how we thought in the market. So we'll see if that continues. We'll dive into that. And of course, many other topics that we're always going to be diving into to try to keep everybody's finger on the pulse of everything that's going on. And in crypto, there's never a lack of information or news of worthy events. That's for sure.
Yeah, I mean, I will say the last couple months we've definitely been a little short on crypto news. Like, we're not getting any of the cool stories like back in the day. We saw a rapper who he fat fingered a transaction for $500,000 and sent that much meme coin to the origin address, effectively burning it. But we are getting that was a good one. That was Ty Dolla Sign, by the way. Shout out to
Yeah.
him.
I will say this, but at the same time, there's a lot of big news that's happening with the structural foundations, and also with the biggest thing that keeps rearing its ugly head is the blacklisting, the kill switch essentially with the stable coins going on. I mean, I know Justin Sun, he's now filed a lawsuit against World Liberty Finance. We talked about that last week.
That
Well,
we did.
he's right back in the news again. Now Tether has decided to get in on it on Justin Sun. Trezor just froze $340 million to Justin Sun's Tron. It's like, why is everybody picking on Justin Sun, man? Like he is just getting like what's the deal? Like why are they targeting him so aggressively? I don't know. We could talk about that potentially if we have time, but it's yeah, there's definitely some newsworthy events, man. People got to pay attention because what you're seeing is the landscape of how this is going to transpire over the years to come on how regulations can be put into place. So it'll be interesting if they actually fix these problems or they're just not. We'll see. I know you got one article that's going to talk about that.
True. Couple good articles that we're going to be talking about here tonight. Number one, I think big news story is just kind of price action going on. We got good things happening for the overall markets, and the crypto markets are actually doing great. They're not pumping by any stretch of the imagination, but we are doing pretty well, running an uptrend. We've been on one for gosh, like 2, 3 weeks, or maybe even 4 weeks at this point. But then outside of that, it seems like things might actually be cooling off internationally, which is part of the speculation about the pump that we're getting currently. But with that being said, the other stuff we're talking about is crypto exchanges are actually getting further into the futures markets, aka leverage, if you will. And then additionally, we have some updates from the New York Stock Exchange about how they're getting further into crypto as well, or at least blockchain technology. So let me know if my screen share is not coming up, but we are going to get going right about now. Da, 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 da. Alrighty, here we go. Looking at classic trading view. So what do we have going on? Well, Bitcoin's $78,000. Kind of crazy to say. I believe last week we were actually right around that area as well. So good to see that it's held up. We did have a small drip, but we didn't even go down and touch the 20-day moving average. That's going to be our light blue line, by the way. And then our teal line, that's going to be our 50-day moving average. And our green one up here, that is our 200-day moving average. So a quick recap from the last time we saw all you fine people. We were looking at this little pocket right here, and then also some previous price action, like looking at our initial dip coming down. But that has pretty much been the area that we anticipated resistance. And guess what? We've pretty much encountered that. Got all the way up to about just a hair under $80,000 on Wednesday, and then now we are currently sitting at about 78,000. After over the last 24 hours, we've pretty much just gone nowhere. Little up, little down, ended at the same place we started. But the major trends that we're seeing with crypto is that right now, the great debate about 4-year cycle versus macroeconomic principles is still ongoing. And as it stands right now, yes, 4-year cycle folks are winning with the top happening right in the time frame. But what we're seeing here is a critical level, because that 80,000 level that we talked about, that's going to be one of the things you really have to get above if you want to even have any legitimacy about some sort of extended cycle theory. Currently, I still have that at less than 10% just because the 4-year cycle case has been so strong. But what we're looking at is that price has been steadily moving. Even sentiment is also going up. I got notifications on my flight over here today that the fear and greed index got all the way up to a whopping 37, which the number is not that impressive. But if you take into consideration that for pretty much the duration of our time here back in the low 70s, high 60s, we were sitting around single digits, which to be at that place for a long time is wild. Granted, we were sitting just a hair under 10 and then we were hair over 10 for a while, but we're starting to see a recovery of sentiment, starting to see a recovery of price. Now the question is, are we actually going to see recovery of the levels that we have to move up and through ultimately? As it stands right now, still below that 200-day moving average, which is our long-term indicator. If we could get above that, there's a serious indicator that there's more to the upside. So to go back to what I said at the beginning, doing well. We're not pumping like crazy or anything though. If we flip over to good old number 2, Ethereum, similar story actually. Looking at a chart, once it loads.
Thing about Ethereum though, it's interesting is like it was hitting up, it's pumping against this, I believe it's the 200 weekly moving average. It fell below. You can confirm that on the chart, but I knew we'd have some resistance, and we certainly did. It's struggling to get back above that. But to go back to what you were saying about Bitcoin, there was a few things we were telling members in our chat room to watch out for, and that was getting resistance right around the 79,000 level in Bitcoin. That would be about a 50% retracement from the recent highs in January 14th when we fell hard to the bottom in February 6th. That's about a 50% retracement. It's a little bit more extended. Typically, when you get a Fibonacci snapback retracement, it's a little bit more violent to the upside, so it's kind of chopping sideways. But there's a lot of reasons. There's some psychological levels, but at the same time, the fib levels were there. So we were telling people basically, if you wanted to, it probably wouldn't be wise if you wanted to trim a little bit. If you had bought in these low pullbacks, maybe pull a little bit off. You don't got to go crazy with it, depending on how much you want to take. But I mean, myself, I actually took a little bit off the table just to have a little dry powder in case we get a rejection or try to retest lows. So.
Yeah, I will say the people that are happiest right now, I think, are actually traders, because having a good sustained rally like this, granted, price went up like maybe 10% when it comes to the Bitcoin price, because we're at 70,000 and then it goes to 80,000. It's a little bit more than 10%. Ethereum, somewhat of a similar story, from about 2,000 all the way up to 2,300 right now. Yeah, Tracker, you are right, by the way. Looking at the moving averages on the Ethereum chart, this is the weekly, by the way. That red line, that is our 200-week moving average. Tapped it once last week, and now it looks like we're trying to test it again. But as it stands, the 20-week moving average did cross over within the last 7 days. So it's going to be interesting to see how these two indicators really shake up, because we don't really see an interaction between these two a whole lot, except really at like market tops and market bottoms. The reason I say that is just due to how long of a time frame the 200-week moving average is. That is like 4 years effectively. So Ethereum has a unique chart, because obviously if we zoom out here, yeah, that's the entirety of the last 4 years right there. Didn't really go a whole lot of places. We went up and then we kind of plateaued out, because remember, it's an average. And when you're going up and down by pretty much the same degree, you're going to end up with an average in the middle. But overall, Ethereum, not looking too shabby, but in my opinion, still following the Bitcoin trend.
Yeah, and you can't really tell because the 200 weekly moving average didn't really start getting calculated until March of 2020 because of the amount of data, at least on the chart I'm looking at. But typically when Ethereum gets below the 200 weekly moving average, it doesn't stay down there for very long. I mean, if it does, it always historically has been a good buying opportunity if you're below that, because it really doesn't stay down there long. And then once it does cross over, it tends to respect it. Like that tends to be a good indicator. Like if you traded Ethereum and you just went off the 200 weekly moving average, yes, I understand you would have fallen pretty hard during March of 2025. You would have blown right through it on February 1st. But once again, we don't stay down there. What'll be here? March 21st. That's what we'll say. What is that? February, May, March. About 4 months we stayed below it. Then again, here we are coming up around another 4 months. So 4 months ish, it likes to stay under there, maybe if not less. So Ethereum tends to try to get itself back above 200 weekly moving averages. So it's a good indicator to watch for, at least for the history patterns of the Ethereum price.
Yeah, once we look at some of these real long-term indicators, you can actually use a couple of those as kind of like buying opportunities for real long-term or like really deep price corrections. I happen to think this is a bit of a time where it could be the case, but also the indicators are only as good as the data coming in. And for the Ethereum chart in particular, the data has been skewed for a while. roughly the last 2 years effectively, because the story that you were covering and breaking, by the way, which is that there was an unfathomably large short on Ethereum, which is why we saw it go from like 4,500 all the way down to 1,600 and then rocket back to 5,000 once the shorts were lifted. Because we had so much time with all that just shenanigans going on, it really jacked up the data. So yes, traditionally the indicator shows when we were below the 200 week moving average, it is a historically low time to buy. At the same time, though, we've had a couple of those for Ethereum over the last few years in a time where those kinds of things should not be happening. So I understand. I think a lot of folks have definitely gotten a little bit lost in the crypto markets over the last few years, but you got to pay attention to what's going on besides just the price, because the price is a symptom of everything else going on: buying, selling, shorts, options, macro news, all that kind of stuff.
But the long-term fundamentals are still intact. That's the thing. That's
Correct.
ultimately has me why I'm holding a lot of my portfolio still. I'm just holding because I've got a much longer term horizon. Now, am I turning into 15, 20% of the portfolio to be trading opportunities? Sure, why not? Why wouldn't you have some insurance on the sideline to be a little safe and stuff like that? And it makes the dips more stomachable. It's more, you can handle it. You can handle the whipsaws because you're capturing opportunities. At the same time, you're not just riding this up and down and really not really being affected. But long term, you have your long term ends. That's why, we talk about it and we talk about it all the time. Don't have your long-term positions, even your mid-term positions, and then short-term positions, and don't turn one into another. Like if that doesn't play out, you should have your entry points, and you should also have your exit points for those positions. Certainly for short-term, mid-term, you probably need to stay pretty true to as well. But if they don't work out, then unwind it. Don't stick long. Don't try to turn it into a long-term investment because it's not the thesis. You just face the facts. You got it wrong. Move on.
That's very true. Gosh, some of the books that I've been covering when it comes to, I want to say it was Market Wizards is one of them, and then I believe Warren Buffett is also famous for saying this. But there's kind of like a weird reverse psychology thing that kind of goes on when you have your winning and losing trades, which is that for the winners, you want to let them keep growing, but realistically, you do have to capture some profits at some point, otherwise they could go down. But at the same time, a trap that a lot of traders fall into is that if you take profits too early, you're definitely going to cap your upside potential. And that's compounded with the other side, which is that theoretically, if you're already losing, you kind of look at yourself and you throw up your hands and you go, "Oh, how much more down could it go?" The answer is a lot, especially in the crypto world, which is that there's theoretically, there could always be another 90% dip right after the 90% dip. That's an option. So the idea that sometimes letting the winners run is realistically the most positive EV play you can make, and then at the same time actually cutting your losses when things are actually going incorrectly. It's the weird thing of being like, in for a penny, in for a pound. Let's see how far down it goes. It's like no, no, no. Risk management. Risk management is the name of the game. Otherwise, you can find those coins that do effectively go to zero.
Correct. And we do talk about that. And any of our members in there that's ever asked for that stuff, we have strategies that we always try to lay out for them because, and it's true, it's definitely a risk management, but at the same time, it's different for everybody. And everybody's going to come back to that same notion. What's your risk tolerance? That's one, obviously. And then is this a long-term trade, midterm trade, short-term trade? Is this a quick trade meme coin that's going to explode and maybe just be a pump and dump? You're going to have to be quick on the trigger. Are these long-term, large macro cap coins that you're trying to hold for the long term for certain plays? Like there's a lot of different strategies here, but the game of the game is you want to capture some of the wins, let some of it ride. Opportunities when it pulls back, you want to be able to get in, get out. And typically you always want to have a game plan. What is your entry and what's your exit, and stay true to that. When things start looking great or things start looking bad, don't try to unwind the psychology. Stick to the game plan.
Well said, sir. I don't know if we've ever talked about it before, but what are maybe some reasons that someone would either have or explicitly not have a trading bag or some sort of small scale trading strategy? What do you
It's a
what's your
time
take on that
factor.
one?
It's a time factor. I mean, how much time do you have dedicated to watching it? In crypto, depending if you're on an essential exchange, can you even put limit orders on? not everything, it's kind of early to crypto. Like we just started recently over the last year or two, starting to get limit orders where you could put it in. And I think that might be also for buy limit orders, sales not necessarily consistent, and you don't have trailing stop losses. You don't have things like that like you do in traditional markets. So there's a lot of products that TradFi could bring to the table. Maybe that what was that Charles Schwab Essential Exchange that they were trying to build with Robinhood? Maybe they'll bring some of those products to the table. But there's so many more techniques like straddles and all these different techniques you can put into place that you can't do that in crypto. And then of course it comes down to long term, much simpler. It's easier, especially if you're just a patient person and you know when things are just destroyed. It's everyone's freaking out. It's blood. It's FTX. It's that kind of situation. That's when you just back up the truck and load up. And if you get in these really great low levels, at least most of your positions at those low levels, you can stomach the ups and downs and long term haul if you've got a long term horizon. Much easier. Midterm, kind of not that bad either. Short term is extremely difficult. And when I say short term, I'm talking 2 weeks. So 2 to 3 weeks tops. Like these are short terms. Midterms, I would say more around a month to 3 months out, maybe a little further. But then once you get to 6 months further out, that's long term. Like I've got things on that I've got convictions I'm just going to keep on. I have so much conviction, especially with Ethereum. I'm not planning on selling Ethereum unless we start to see, $6, $7, $8,000 price ranges. Would I even start to unwind some stuff at those levels? I mean, the longer term positions, like I'd have to see it to be worth to take some profit off, just because I don't want to get greedy. It goes back to risk management. But ultimately, short term trades, people need the time. You need to do your investment, your time. You got to be very you've got to take the human emotion out of everything. And people will say, "Oh, that's why you use bot trading and you use puts and shorts and stuff." And you put all these different products in place to mitigate the human interaction. But what happens is when things start going up, you start thinking like, "Oh man, this thing looks like it really wants to run hard. So I think I'm just gonna let it ride." And then all of a sudden, before you know it, it's rolling over, and then you're like, "Oh God, what should I do? Should I?" And you start second guessing yourself. That's where you've already fumbled the bag. You've already fumbled. This is why you've got to put in, before you even get into it, if it doesn't do what I think it's going to do, where am I willing to sell out? If it goes up, where am I willing to take profits? And not just my first profit, second profit, third profit. There's tiers to this. And then same thing to the downside. How much am I willing to risk to the downside? What percentage am I willing to risk for that? So you want to calculate all this, figure this stuff out even before you even put anything on. So it's time consuming. And not everybody's
Yeah,
willing to put
time
that
is a
kind of
big
time.
one.
Yeah.
Oh, it's very time consuming.
That
Not
and it's
just from
difficult. Well,
the
well,
physical
one more
amount of
thing.
time that you have.
One more thing. It not just time, but it's also very short term is very difficult. The shorter the time frame, the more difficult it is. But when crypto is getting beat up as bad it is now, if you feel like you're getting closer to the bottom, it's much easier to play around with short term trading, because you have a more probability of holding up. Now, most people in the clever influencers are going to tell you, "Oh no, we got another drop down to 40,000. I'm willing to hold my positions longer." Like I'm I don't know. It's tough to say. Once you've been in this thing for so long, you've seen it all, and you've got to get burned quite a few times before you learn the lessons. And that's where you become an experienced trader. Even though you can sit there and tell people till they're dead in the face, "Don't do this, don't do that." Typically, somebody's still going to do what you tell them not to do. But hey, live and learn.
That's true. Yeah, this could theoretically be a cheap education, or depending how much money you put into it, trying to learn to trade could be a very costly education. And
The cheapest is
honestly,
learn from everybody else's mistakes.
agreed. That's the best one if you can. Either that or just hit it out of the park on the first try. But odds are you're not doing that one. That does kind of bring me to one of the points that I would talk about for people that are considering having a trading strategy on top of like a small on top of the investment portfolio. And I think size is a question about it too, because you just talked about it and you nailed the number one point, which is time. It's not just your time horizons, it is how much time it takes out of your day. And it's also the amount of time that it requires to get educated and experienced. Once you've done all of that, now the question is, how many poker chips are you putting on the table to use the analogy? Don't be gambling with trading, because if you're doing that, you're fundamentally not trading, you're just gambling. And believe me, there are plenty of casinos that are more than happy to take your money and give you a close to 50-50 coin toss on many bets. This one is different though, which is that you're putting in hours, you're putting in your time, your effort, and ultimately your kind of longevity, because you're going to be doing this for a hot minute, hopefully, if you're going to get good at it. And at the end of the day, the question is, okay, you put in all this time and effort. What did you get out of it? If you have a relatively small portfolio, you have to think in terms of percentages, because that's what you do with trading. You're trying to look at the percentages, not the overall number. If you look at the overall number and it's too big and you feel bad, A, you're probably trading too much, and B, it could be a lot of losses. The flip side, though, if you don't have that much to put into it, the trading doesn't really make a difference. It's not gonna kind of catapult you to like the next level. It's not gonna add an extra zero theoretically. What you're gonna do is you're probably gonna get maybe 50% to a 100% gain over the course of like, I don't know, like maybe 6 months if you're killing it. And that's also including the ones that don't work out. Because guess what? They all don't work out. Because there's these things called black swan events, weird market corrections, things that you don't see, like Binance just ruining the market, that kind of stuff. So if you don't have a large enough portfolio to trade, it's not really worth the time and effort, in my opinion. By the way, nothing we say here is financial advice. I'm just talking out of experience on this one. Playing around with it, though, will definitely help you build some other core skills that you can use as a crypto investor, though, because you're going to start to recognize things. You're going to develop that gut for making decisions. You're going to be able to look at the charts and understand what's going on, understand the news and the fundamentals and how they affect price. So just because you're not trading doesn't mean you still can't be paying attention to these things and learning how to do them. So if you're actually trying to get value out of it and grow a portfolio, you got to have a decent amount of money to put into it in the first place to even be worth your while. Otherwise, honestly, just stick with your day job and then just try to buy the lows. But at the same time, though, I think it's still a worthwhile effort of trying to develop the skill, even if you use a dummy account on a lot of sites that allow you to do that kind of stuff where you have fake money in your account, but they still let you use the real trading window, use all the tools that are available to you, market orders, instant buys, limit orders, that kind of stuff, trailing stop losses if we would be lucky enough to get those on a crypto exchange. My God, I miss those from the old stock trading days. Those are fantastic, by the way. But understanding how the market moves, understanding how the charts work, understanding support resistance levels, a little bit of like some trend stuff if you want to get into the Elliott wave, or if you want to go deep on a specific one, looking into like Bitcoin 60-day cycles, that kind of stuff. It'll help you understand where you are at any given point in the market. Instead of just trying to have a super zoomed out look, you can look in a little bit closer and be like, okay, within the next 2 months, what is the best opportunity to make a purchase?
And there's something else that people don't quite understand too. In a crypto, it's even more so. If you're on a central exchange, your transaction fees are pretty much locked. They're set. But I mean, if you're trading with a small amount, I mean, the transaction fees can eat you up pretty quickly depending on how frequent you're trading. Then the other thing is, in DeFi, it gets even more complex if you're not sure about slippage and how much liquidity a pair has, things like this. There's a whole other world though. So like I said, we've been there, we've done all this. I mean, we'd be more happy to help people out on that stuff. It's just that it takes more time to get into it. But it's not necessarily complex. It's just you have to understand it, and then when you're doing it, there's ways to check to see how much is there to avoid slippage and things like that, because people have gotten destroyed on it where they'll go in there and they'll make a trade thinking, okay, I'm gonna make this trade, not understanding slippage, and get just absolutely wrecked. So they might have been up, let's just say, 200-300%, 2-3x on a position going to slippage, and all of a sudden now they only got 150% because they didn't take into consideration the slippage. Or when Ethereum's transaction fees, when Ethereum gets really hot, transaction fees were getting ridiculously expensive. So you might have had a great winning trade, but can you sell it because the transaction fees were so high? Now it looks like they've kind of, I'm not gonna say solved it because it still has yet to be proven, I think. Yes, the transaction fees are definitely lower, but have we seen the kind of explosive transaction rates when everything was going parabolic in Ethereum? We haven't quite seen those yet. So it's the jury's out still. So there's things like that you got to look at. And then what time are the transaction fees lower? Because there's heat maps that can tell you, okay, when is the time to trade? When is it quiet? When is it most aggressive? So yeah, there's a whole much other world that you have to take into consideration. You can't just jump out there. Even if you're in TradFi and you've been doing it for years, you don't understand some of these things until you get out there, because in DeFi world, it's definitely different.
Oh, for sure. And you raised a great point though, which is like DeFi kind of DeFi is a wonderful opportunity, but it also complicates things. Trading is honestly, I think, one of the things that complicates the most because if you're on a centralized exchange, you're probably paying a percentage of whatever trades you're trying to make. But like you said, if you're trading through DeFi, you're paying gas fees on top of whatever small fee the exchange might charge if it does one. And at that point, it's a difference between like if you're playing on the centralized exchange, you kind of just have it baked in that your whatever move you make has to exceed this threshold. Otherwise, it will not be worth the fee that they charged you to get there. For DeFi, because it's a flat fee based on the gas, well, then it's a question of how big is the gas fee in relation to the trade that you're making. If you're trading like, gosh, probably like over hundreds or maybe even over $1,000, the gas fee theoretically should not be eating into it that much. Your position size is so much larger than the gas fee, it's not eating the percentages out of your gains when you're making them. But in DeFi, like you said, the gas fees, they're not constant. They can go up and down on a daily basis. They can definitely go up and down over the seasons. We've seen it. Gosh, I remember people were making people were just making like simple swaps back in 2021, 2022, and sometimes the Ethereum gas fee was like $50, which is wild.
Oh, that's nothing. Come on now. There was times when Ethereum spiked and it was like $1,500 for a transaction. I mean, it was out of control. I mean, people were getting destroyed on transaction fees with Ethereum. That was just a few years ago. Like I said, I think they've done some recent upgrades to hopefully that resolves those problems. But like I said, I don't think we've seen that level of transactions. It became a bottleneck. So hopefully they got it under control. I just don't think we're going to see those kind of
I hope we don't see those kinds of transaction fees anymore.
transactions. Well, like,
And
whether you like Richard Hart or not, it's just why he created Polish chain because of the disgusting high fees.
yeah, one of the great ironies though is that ever since Pulse Chain came out, the Ethereum gas fees have not gotten bad again. But that's partly mainly due to Ethereum's lack of performance, if you will. Alrighty, tell you what, let's wrap this up. So, why would a person consider trading? What are you giving up? What are you getting? It's going to require time, both on the computer, learning the skills, and then also being in the market. It's going to require a certain amount of portfolio size to make your efforts worthwhile. And then on top of that, you got to have good risk management and mitigation, both from the strategy you build, but also yourself, because the emotions will get a hold of you, especially the first time around. It's like, gosh, remember the first time you ever played like a new sport or something? And you feel that adrenaline rush and you feel like you're making all these stupid mistakes. And then after the game, you're like, those are rookie mistakes. What am I doing? I might be talking about myself as I've been picking up hockey lately, but it's that kind of stuff. But imagine that with trading and the money that you've worked so hard in your life to get. So there you go. Kind of the pros and cons of having a trading bag. If I had to outright say it though, odds are most of the people interested in the crypto space, I would argue you don't need to be trading. In fact, it's probably not going to be advantageous for you. Again, nothing here is financial advice, but what I've seen on average is that you're either not willing to put in the time or energy, or you're not big enough to do so yet. And then on top of that, there's just better options that you probably have in your unique circumstance. So figure it out for yourself. Alrighty. Let's get rolling to the next one. Real quick, I do want to give some shout outs to some friends that are showing up here. We got Mr. Marcus 72 saying, "What up, all? Good to see you, sir. Thanks for stopping by. As always, really appreciate you." And we also appreciate Chad Donnerschwans. He says, "Hello, fellow base crypto pros, checking in and locking in." Yes, sir. Checking in and locking in. What we're locking in on, it might be up to a dealer's choice on this one. Could be some good buy opportunities for the long term. Could be some, short term trades or whatnot. But either way, yeah, locking in for sure. Alrighty, on to the next one. So one story I want to cover here tonight is this guy. So we're looking over at fxleaders.com, and we have a story from them. Crypto exchanges line up for U.S. perpetual futures as regulators prepare to open the door. The perpetual futures, often called perps, are derivative contracts with no expiration date. Traders can hold leverage positions on crypto. Here we go. Which because you can hold these leveraged positions on crypto indefinitely. It makes them popular, but also genuinely risky, particularly for the retail investors who may not fully appreciate how quickly leverage can turn against them. Global trading volume in these instruments hit $61.7 trillion last year, up 29% from the year before, almost all of it happening outside of the United States. CFTC chairman has made bringing that activity back on shore one of his priorities. At a Milken Institute event in March, he put a rough timeline on it, saying guidance was coming within weeks. His position on what went wrong is pretty clear. The prior administration left the space without rules. Firms moved their operations abroad, and liquidity followed. Getting it back means giving the industry something concrete to work with. Exchanges are already moving. Coinbase, popular name there, has self certified perpetual style contracts with 5-year expirations and up to 10x leverage, a workaround that gets close to the real thing within current rules. Binomial remains the only US platform offering full perpetual futures through self certification. Kalshi, better known for its prediction markets, is preparing to launch crypto perps in the coming weeks. Polymarket made a similar announcement on Tuesday, opening a waitlist for early access to leverage trading on Bitcoin, Nvidia, and gold. Okay, what are we looking at here? Well, looking at more ways to gamble, theoretically, if that's how you view this. As the article pointed out, perpetual futures with up to 10x leverage, yeah, that's some very high risk stuff. And could it theoretically be your ticket out of the crappy neighborhood? Yeah, if you hit it, but based on 10x leverage, odds are you're probably not, and you're probably going to get stop lossed. This is something we've talked about consistently on the show, which is that doing option style trading contracts in traditional markets, it makes sense if you know what you're doing, because those markets don't move that much in any single given day. Crypto markets, on the other hand, can move a lot in one given day and end up in the same position. Even just looking at that chart that we pulled up earlier for the Bitcoin, within the last 24 hours, we moved up and down about 2.5% either direction. On a 10x leverage market, theoretically, that could be enough to get you stop loss, get your leverage checked, liquidity checked, all that kind of stuff. And all for what? The price to end up at the same point that you started out on? Seems kind of wild. So, is this some risky stuff? Yes, but more people are getting in on the game, and there's some big players that are doing this. As the article mentioned, Coinbase is trying to mimic the effects currently, and there's one other person that actually has this style stuff, but the regulators are actually trying to encourage this sort of thing, whether it's because they truly understand the markets and what people want out of them. This kind of thing, I would argue, possibly no. But the exchanges like offering as many tools as possible to people, and professional traders like having as many tools as possible to have at their disposal. So seeing this kind of stuff, this is just the crypto exchanges getting further into the game and offering more ways to play, hoping it's going to attract somebody, whether it's the amateur trying to strike it big or the professional trying to actually use these tools to a specific measured effect. Overall, though, the article mentioned as well, this kind of stuff went away after the last administration, namely after there was a lot of shenanigans with the SEC claiming that pretty much anything crypto is a security, so they took control of it, and that's why you didn't see this stuff happening. More favorable conditions now, so we are seeing it happen again. Overall, is this going to change the markets? I would argue probably not. What do you think, Tracker? Is this a game changer or just more of the same?
This is another tool that the market makers are going to use to just absolutely liquidate investors.
I agree with you there.
These are products that they put out because they know that people want to gamble. So they're going to put out these products, and because they're traditional TradFi, so all the products that are on the TradFi are coming to crypto. Okay, period. Now, in crypto, like you said, they move a lot. We've done this so many times on the show, showing you where the liquidation levels are for big orders. So you could almost see the price, whether it's any crypto price, you can see it gravitate to where it's going to liquidate the most amount of people. So market makers will move that price to liquidate everybody, and then they cause the price then to go back toward the next level, whether it's to liquidate the longs, to liquidate the shorts. And here's the other thing you got to be careful on. Binance, I'm calling them out because they've done more shenanigans, I think, of all the big central exchanges than anybody. They're the ones that brought us the collapse that happened in October that triggered this whole thing. They're the ones that also during that time allowed for, and there was a lot of insider trading that took place. And what happened in there was very interesting. So if you had, say, a long position on and you had a short position on these leverage trades, what was really messed up is not only would they go down on your long positions, it would basically give you max pain. So that level would drop really hard low, and then they would liquidate you at a lower price. But even your inverse that had the safety net in, they went ahead and liquidated those right away, or they closed them out because they have their order to, they can close out these orders anytime they wanted. So you think you have protection on both ends, but they didn't. They not only did they liquidate your bet you had on wrong, but the one you had on right that should have protected you, they took that one off quickly. And they quote unquote stated, because we didn't have enough liquidity to fulfill all these orders, that's why we had to close out certain orders for other people's positions. So yeah, just hear me out. Don't do leverage trading. Don't do leverage trading.
That's fair.
Period. Just don't. I mean, there's no need to do it. Crypto is going to give you a lot of gains in one direction. You don't have to do it. Now, in the traditional markets, you have puts and calls. You've got double and triple leverage ETFs. FYI, if you don't know how those work, don't mess with them either. I mean, because they get reset every day. Those are actually designed to both go to zero. So what the traditional markets did when the double and the triple ETFs came out, they shorted them both. But the problem is you can't even get in on those orders. They're all shorted and maxed out. So they're making money on that every day because they both, the way they reset every day, they gravitate towards zero. So in the short term, you can make money, but the long term, they can go to, they're going to gravitate towards zero. This is why they're always doing a reverse inverse split on those leverage ETFs. So here's the thing. The house always wins, and the house is Wall Street. The house is the central exchanges, and they're going to provide all these products for you to gamble with. Just be careful because the game is rigged, is what I'm going to say. And even though you feel like you're putting on a bet that might be safe, they'll still find a way to take out both sides, like they did with Binance that happened in October. Just these are examples we see time and time again. So personally, I would just hold your positions. Don't try. It's enough complications enough as it is. You don't need to leverage anything.
For sure. Oh, believe me, I'm not touching these things with a 10-foot pole. But the reason I brought this news story up tonight is I wanted to ask the question: does this help or hinder the crypto narrative going forward? You mentioned it previously, which is that all
Yes and
TradFi
no.
tools will eventually
Yes.
come to crypto. This
Yeah.
is one
Yes
of
and no.
them, but at the same time, this is a particularly dangerous one of many, I will say. But this,
Well,
I think that more people are going to get wrecked than actually make money when it comes to this kind
they're
of
going to
stuff.
get wrecked, but the derivatives market is the largest market in the world. So that's going to bring more big players to the market. The reason why I don't like a lot of these TradFi products is because the level of manipulation that's going to instill in crypto. This is where do we get capped off runs? Are the days of 20, 30x moves, are those days gone? You know what I mean? Like this is starting to muddy up the waters of TradFi being involved. So I'm not happy about it because it's the same thing in why the ETF price, Ethereum should be much higher priced at where it is today. We never really got a big strong rally on it because it was getting shorted right around when the ETF for Ethereum came out is when it really started getting suppressed. So no, these are more products that the institutions, central exchanges will make more money on because it's going to increase transaction fees and product fees that they're going to provide to customers, and yet it's going to allow for more manipulation in the market, whether good or bad. We'll have to wait and see, but I just feel like prices will be getting. It's just going to lead to more manipulation. That's ultimately what it'll come down to.
I think I'm in agreement with you there, which is that there will be more manipulation as a result of this because these kind of tools they're designed for leverage. Leverage has the ability to skew markets, and I think you're entirely right in that point. I think that overall, outside of that, this does technically fall into the category of this is a win for crypto. The reason I say that is also with a very big asterisk, is I'm going to call it a vanity win, which is that is this really going to help people? No. Does this give off the appearance of a more mature and more realized crypto market? There, I'm going to argue yes. because you're seeing more of these tools ported over from traditional finance to the crypto markets, it's showing that these are similar. It's not blurring the lines, but it's making them approach together. Be like, look, crypto moves just like how TradFi does. Shouldn't these things be equivocated then? And at its face, you can kind of be like, yeah, that does make sense. If you really dig deeper down into it, though, crypto is similar but is different on some very fundamental basis than traditional markets. Specifically, we're not trying to calculate profit and earnings ratios. We're just looking at the value of an asset compared to the value of other assets, that kind of thing. But overall, I think that this is another grain of sand in the pile that is crypto maturing and crypto becoming more legitimized.
No, it's definitely a sign of a maturing market. There's no doubt about that. It's just that with a maturing market comes a lot of the manipulation that we don't necessarily want. Like the
So,
days of an organic market, those days are gone.
so you're saying that they added perpetual futures contracts and the monkey paw had another toe curl in.
Okay, yeah, sure. You can call it that, sure.
Fair. All right, tell you what, let's go to the other side of the house. I got something from these guys I want to share with everybody. So, looking over to good old Binance, but what's this? Binance is reporting on the New York Stock Exchange? Okay, sure. Let's see what they have to say. Stock Exchange is investing heavily in digital assets and plans to build a 24/7 trading platform on blockchain based securities. Centralized with high barriers to entry and closed on weekends, the stock exchange was, in its very structure, a symbol of everything that Bitcoin was meant to disrupt at its inception. Yet, the 233-year-old Wall Street giant has quietly transformed itself into an unexpected leader in the cryptocurrency world. From investing billions of dollars in the digital asset space to planning to launch a 24/7 trading platform for blockchain securities, the legendary exchange is undergoing its most ambitious and potentially riskiest transformation ever, reshaping the old system to use distributed ledger technology behind Bitcoin. Here's a quote. We have always been at the forefront of the market's evolution from analog to electronic. I believe we are now entering a new wave of moving from electronic to digital. This is coming from Michael Blaugrund, the vice president of strategy at Intercontinental Exchange. He said he foresaw a highly probable future. Blockchain will become an important vehicle for the stock exchange core business, including trading, clearing, settlement, financing, and data distribution. It was under the leadership of Jeffrey Sprecher, founder and CEO of ICE, Intercontinental Exchange, that this belief was translated into action. According to sources, they invested approximately $200 million in cryptocurrency exchange OKX in March of this last year. This deal valued OKX at 25 billion with a B dollars, and just a year earlier, the China-based exchange had paid over $500 million to settle a federal investigation. This investment is just one part of a broader strategy on Wall Street. From prediction markets to cryptocurrencies, previously considered high risk and off limits institutions are once again paying attention. The Trump administration's favorable regulatory stance on non traditional financial assets, coupled with investor demand for such high risk transactions, has fueled this trend. The New York Stock Exchange bets on cryptocurrencies come at a time of hardship for crypto bulls. Bitcoin just experienced its worst start of the year since the first quarter of 2018. Recently, the price has hovered around 75,000. Yeah, fair enough. Alrighty, so what we're getting here is that bit of another puff piece, but this one is again pointing back to stock exchange going blockchain, and we even get the actual experience of OKX, which is one of the centralized exchanges. They're actually getting a good chunk of investment coming into it now from the New York Stock Exchange style folks. And if you remember stories we covered previously, where we actually had, gosh, Scott Bess, no, not Scott Besson, Paul Atkins, the head of the SEC, was saying that he set a very ambitious timeline for the exchange going to blockchain. He said it could happen within 2 years. Okay, well, we had the guy doing the regulatory stuff say 2 years. Now we're starting to see some articles saying that, yeah, people are actually putting money into making it happen. So, is this the whole enchilada? Absolutely not. Are these again individual flags that are pointing all in the same direction, suggesting that we're heading in a specific way? I would argue, yeah. So, the reason I brought this one up is previously we talked about the SEC talking about going on blockchain. Now we have people actually putting money into exchanges to get their foot in the door and actually try to, get ahead of the blockchain curve. A lot of people and a lot of firms did that when it came to the ETFs, specifically trying to launch the spot ETFs. Shout out to Grayscale. They've been ahead of the game for a long, long time, but everyone else has caught up to them pretty quickly when it comes to the ETFs. Now, if we can see kind of the inverse happen, which is traditional finance go to block traditional finance go to blockchain. Now we're bringing blockchain to traditional finance. So could be a big step up for the technology, but then again, we don't know what blockchain technology they're going to use. This one's claiming that they're using Bitcoin-based technology, but at the same time, if you did a quick Google search, you're going to see that there are tons of people writing articles about how Bitcoin is possibly already quantum computing compromised. And it's like, okay, if that's the case, then why are you putting the world's largest exchange on something that is compromised? What are we doing here?
Well, it's fun, and these articles, we've been seeing these articles come up for a while now, and I know the head of the Nasdaq and the head commissioner of the stock, they've been talking about how they're going to move everything they're going to move it all over. Like we've known about this. It's just, when is the time coming? When this is a little bit more information coming out now that we know some of the players involved, but they're gonna. This comes back to we keep talking about real world assets and tokenization that we were talking about last week. Stocks are going to get tokenized. Anything that has anything tied to a digital receipt is going to be moved to tokenization, or a candidate to be tokenized, and including overall markets. So I think very much how AI impacted the world and people didn't realize what was coming just 2 years ago. I think the same is going to happen with tokenization. I don't think people realize what now the average user is not going to really see a difference in their world. Like they're just going to think, all right, the app's doing this. They're not going to see that, but they're not going to realize everything's tokenized, and they're not going to understand what blockchain is it on and what's the transaction fees, Metcalfe's law, and all. They're not going to be looking at that. But yeah, this is this is just one of many things going to get tokenized. I know
That's
we were
true.
looking at DeFi Llama, right? And there we were looking at the real world assets, and stocks
On that one in particular,
is one of them.
line go up. Line very much go up.
Yeah, and the stocks are gone. Stocks are on the list. It's one of the categories. And if you're
That's
not sure,
true.
I'd recommend going at DeFi Llama. Look under the real world asset. We talked about it last week. Stocks and equities is number 4th category on the list, behind bonds, M&F funds, gold and commodities, private credit, and then of course number 4, stocks and equities. So it's
There you
coming.
go.
It's
That's
coming
true.
very quickly, man. Yeah,
You
it's
you
just
mentioned
another.
one of the dirty words. You threw out AI out there, and I think that this is an interesting comparison point, because what we're seeing right now is that a lot of companies are trying to. I think we're going through a couple phases past the initial launch, but companies were like, "Oh, we're AI powered," and it's like, "Okay, how?" And they're like, "Oh, we just use Chat GPT to, I don't know, like take notes." It's like, "Okay, great." Now there's been a giant push for companies to be like, "Yes, we are AI driven. Like all of our employees, you got to use AI for your work. You got to use it." And then the employees are like, "How? Why? Does this do anything for us?" And the answer is not really. So we're kind of seeing these stages of adoption, or rather forced adoption, that aren't working. And I think we're getting to the point now, we're actually seeing reports of employees. Shout out to Gen Z. They've been the leaders of this one, but actually sabotaging AI in workplaces for these to kind of push back against it. Now, you could look at the adoption of blockchain technology as possibly taking similar steps. But hear me out. I think we've already crossed that hurdle well before this, because last cycle, NFTs were massive, and I think that honestly kind of was the straw that broke the camel's back when it came to this sort of like forced adoption phase, which is that a lot of things looked at the blockchain technology even before that cycle. Like there was a blockchain about like Dentcoin, which was a blockchain designed for dentists to use a cryptocurrency to settle payments. Spoiler, that thing is no more, but that idea did happen, had its moment, and it went. All the altcoins had their moment, they've gone. DeFi really had its moment back in the sun, back in the 2017 cycle, I want to say, and it's still around, but it's not the craze that it was then. And then this last one, we saw the rise and fall of the NFTs and the Bored Ape Yacht Club and all that stuff. So I think that actually actual adoption of blockchain technology, I think, is so much further along than people realize. Because it's easy to look at AI and how AI is kind of like all the craze right now and all the pushback and all the forcing it and stuff. blockchain already went through that whole cycle multiple times, by the way, with the different iterations of it. So now that we're actually seeing people naturally and organically want to adopt blockchain technology, I think that this could really be the moment for it to happen. I'm not saying it's guaranteed, but I'm saying that we have already got out so many of the stupid things, the hiccups, the dumb stuff. It's out of the way. It's in the past. Yes, we all look at the Bored Apes Yacht Club stuff, and we point and laugh at the monkey picture that was sold for $100,000, that kind of stuff. But now we're actually looking at the adoption of the core technology itself for the purpose of the core technology, and I think that that's a big win.
So AI to me, and I'll keep it true. AI to me is .com all over again. Companies want to jump on the bandwagon to think, hey, yeah, we're cool, we're hip like everybody else, we're using AI, we're going more digitized, we're using all the buzzwords, right? We're going to be more synergy, all this other crap they want to throw around. So companies are going that direction, certainly. But once again, where's your product fit? Just like when .com came out, everybody wanted to go e-commerce, everyone had to build a website, but they didn't know what to do. They just know they wanted to go. So people are just throwing money at this, just like they're throwing money at AI. So they're going to overspend, and then there's going to be a bunch of losses. All the dreams and hopes and promises that were say you're going to save this much money, they're going to realize isn't going to happen. It's just like going to the cloud too. Companies are migrating to the cloud. They've started realizing over the last few years it's not what it was advertised to be. A lot of companies are starting to go back to on premises and handling hardware themselves. But what I'm getting at is this stuff is all good. It's just what's your product fit and what are you trying to utilize? You can't just jump into it and go after it. Now, with real world assets, this has been going back and forth. Institutions have been looking at crypto now already since probably around 2008, 2007, seriously. And because they've always been fascinated. All the banks have been looking at cryptography and on the blockchain, and they like how it's a ledger. They like how everything's organized, structured. They love the fundamental technology of it. Okay. They were already on board with it. The tokenization is already happening. I think you're going to see a pendulum swing pretty heavily in one direction. But just to put this in perspective, exactly 3 years ago today, there was only $1 billion in real world assets that were tokenized. Now today, we're sitting at 26 billion. So in 3 years, we've gone from 1 billion to 26 billion. And that is going up. And that chart, like we showed last week, is starting to move much more like a hockey stick. Like it's going to go more parabolic, because with this, everyone's going to be trying to get on, because what they're all saying is this: it's more cheaper, it's more efficient, it's more secure, and there's less paperwork. All these problems that companies have, they don't want to deal with all this stuff, and they can move to tokenization and on chain, and it solves a lot of these issues that they're having, and it's making it more cheaper. So they're going to absolutely flock to this a lot quicker. Now, they're going to people stumble and mess up on this, yeah, because once again, it's going to be a new product, a new thing they're going to try to chase and go after. But the institutions out there that are successful, and just like any of these technologies, the ones that do come out of the rebel, that know what they're doing and how they're going to utilize it, are going to be going great going forward. But the fact that, like you're saying, the fact that you're already seeing a company like the New York Stock Exchange that's been around for, what did they argue, 230 years? I mean, you got to wrap your head around this. This is the first time we're ever moving this stuff to like, I get it. It had upgrades during the internet. I understand, but now you're moving into now what we call 3.0, and they call it Web 4.0. That's quantum computing, but we're not going to go there. But we're going to go to 3.0. That's what we're moving to, and this is real world assets tokenization. It's Web 3.0, and that's where we're heading to. So the adoptions come in. This is why we invest. This is why I'm invested heavily in that area, because this is real world. This is where it's going. This is what's going to happen. And I think more people are expecting Ethereum to be the one to benefit on this. Like we talked about that last week. We keep talking about it because they have they have the lion's share of assets that are tokenized. So that's why you'd want to look at them. Yeah.
Well said. Well said. Gosh, I really think Ethereum is probably going to be the one. The reason that Ethereum is going to be the one, it's just head and shoulders above all the others when it comes to trustworthiness of the actual use case and the reputation that goes with it. If you want a smart contract or some sort of decentralized app, Ethereum is the place for you. Granted, there are a lot of other chains that work honestly kind of better, but they just have worse reputations. I'm specifically looking at like Solana on this one, which is that the transaction speed on Solana is a lot faster than Ethereum. But at the same time, I don't think people take Solana seriously for building DeFi apps and doing tokenization stuff. I don't think that's the case. It would take a massive shift to get Solana or some other blockchain up to the level of Ethereum. But from where I'm standing here, I think Ethereum is the clear choice.
Oh, and I think if you look at all the pieces that keep getting laid out to do that, so right now there's $26 billion in real world assets tokenized. Ethereum has $16.5 billion of it. So more than half. The next in line is Binance at 3.8. The next in line is Solana at 1.4. Stella at 1.2. Arbitrum, half a billion. So it's a huge drop off. So Ethereum absolutely is the most. And if you look at the chart of real world assets that are growing, you can see Ethereum is starting to really separate itself from the rest of the pack. I mean, they're really starting to move, it looks like. So that's how I take it. I don't know. We'll see. We'll see how it comes. But then I look at people like, Tom Lee and those guys from the treasuries, and they're betting on Ethereum. And they're
Betting
showing
big too.
and they're betting very big, and they're showing you where it's going on. And the Kathy Woods, the people who have a big name for themselves in TradFi for innovative and disruptive technologies, that's what they mainly focus on. And I remember Tom Lee, he was on Fast Money on CNBC. I forgot how long ago it was. Was it 2019, 2018, where he was saying you want to be owning Bitcoin, and now he's saying now you want to be owning Ethereum. So
Yeah.
is it gonna come back around? Well, these guys have so many people working data and analyzing everything in the world, and that they're analyzing every possible scenario, and they're going heavy on it. So sometimes it's just best to stick with the smart money on this one. I mean, they have huge track records. So ARK Investments, Kathy Woods, that's another one. They're all looking at it. So sometimes don't overthink it. Sometimes it's just, you just got to follow the money and where the money's going, and that's where it's all saying it's going. So, yeah.
True. Alrighty. As far as our story goes, I think Paul Atkins is maybe a little too visionary for the rest of us. He's saying 2 years. Realistically, I could see 4. For
Yeah, I would say
exchange.
I would say that comes down to the administration. It's too loaded. Like, you have a very pro crypto environment right now. Administration. If we can't even get the Clarity Act passed this year, chances are you can push that even further back. Will the new administration be pro crypto? Will they not be in favor of crypto? What I will say is this: there's plenty of company or countries out there that are willing to move in this direction. I'm looking at Dubai. I'm looking at places like Singapore. Some of the other places out there, that China certainly. So if the United States wants to fumble this, they can't fumble it too much more, because the technology's there and they're going to go in that direction. So
Yeah.
they need to not mess around with this, and go ahead and move forward. And if you believe in the new world order, and you talk about the whole digital IDs and all that stuff like that, this is the fundamental basis for this to happen, because this ties everything together. This ties all the medical records into the clouds that are already been moving in there. This now tokenizes everything that's on blockchain, and then ties it to real IDs that have all this other stuff tied together. So you're asking the question, how could they do something like that? And this is how you do it. So whether it comes to fruition or not, I'm not going to go down that rabbit hole, but this is how you build out that structure.
Yeah. That sounds exactly correct to me. Gosh. Alrighty. Tell you what, though. We covered macro markets, Bitcoin, Ethereum. I even ragged on Solana a little bit. I did give it some praises, though. I'll say that. Fantastic transaction speeds. Almost instantaneous, I will say. But if you are looking for analysis of other tokens, guess what? You can find it over inside of our private Telegram. We just wrapped up early on Monday, rather. We wrapped up a nice long live stream covering Pulse Chain and a lot of the projects going on with Pulse Chain, talking about the tokens, where we see the viability of Pulse Chain and everything there. So you can catch that along with all the other stuff that we do in the archives over inside of our private Telegram. If you want to join, you can head on over to walktheblockndf.com, find the membership tab, and that is where you can get inside of there. Around here, we like to say the waters get rough, so don't sail through them alone. Come join us as we navigate digital finance together. private mentorship, exclusive live streams, Q&A. Go from beginner to intermediate to expert with us. So we all work together, we can all win together. That's for sure. Alrighty, sir. I know, bit of a shorter stream compared to the hour and a half fest that we had last time, but overall, interesting moves out of the market. Any final words on anything we've covered here tonight?
Well, I think the most thing people are always going to be, I mean, all the stuff we talk about is interesting to know about the direction you're going, the news. We try to keep on top of everything, but obviously everybody cares about price action. So there's two major camps right now. Everybody, the bears, they're thinking that, hey, this sideways to up trajectory move is a slight consolidation before we break down and drop. I think a lot of them feel that way. If you're looking at the Bitcoin chart, we had sideways movement action from November, and then we finally broke through it on January, and that's when we had the big fall. Then everybody's thinking we're going to have another fall similar to that. We're kind of grinding up slowly in Bitcoin, hitting some resistance, which is typically normal. It's not to say that it's going to get rejected there or not, but we are grinding up. And then we're supposed to break through and drop. A lot of people feel like if we're dropped that far from, what was it, January all the way until February, we should drop then somewhere around that $40,000 range. That's what everyone's looking at from the bears. I'm not in that camp. I haven't been in that camp. I think the institutions don't want to give up these. And we know the markets are heavily shorted right now. They're very, very, very heavily shorted. And if they're shorted, then this goes back to the derivatives play and liquidating people, right? So the market makers, why would they want to give up the price when they could liquidate all these shorts, right? They're going to want to try to liquidate the shorts, and they're going to want to try to keep the prices up, because if everybody wants something, typically when everybody thinks something's going to go in one direction, it doesn't ever go that direction. So I would say the contrarian move is either sideways chop. That's why I'm saying having a trading bag, or long-term, holding your positions for long-term. That's what I'm stating. I don't think, if you think if you're on the sideline and you're shorting right now and you think it's going to go down lower, you might be right, but I personally wouldn't be playing that game. If you think the market's going to go and you're on the sidelines, I would personally, I keep saying it again, nibbling here and putting something back on at these levels is just risk management. What happens if it drops? What happens if it doesn't come back to the levels you think it's going to come back?
What? No
Are you going to get?
40K? Come on.
Or let's say it doesn't. Let's just say it keeps grinding up. Now people will say, well, if the Clarity Act doesn't get through it, then we're going to go down. But here's the other thing to take into consideration: we had everybody freaking out about the war. Now are we on? Are we back off? Now they're saying it's going to go back and forth. But what have the overall markets done? They've hit new all-time highs. They're handling this no problem now, because the markets have had time to digest. This is why the VIX is so low. It's down at 19. That's nothing. We spiked up to around 35, and then we came back down. So the markets aren't scared. They're not worried about any of this stuff. So everything tells me that they're able to absorb this risk, and they're not willing to shake it off. And the Russell 2000 hitting all-time highs tells me the risk's gone. They don't have a problem with the risk appetite. So if that's all in place, then why should these markets go down? And overall macro markets don't roll over like this. We just broke out to all-time highs. If anything, it'll come back a little bit, maybe backfill to the breakout and have some chop sideways action maybe for a little while, to maybe then start its next leg up, or maybe finally starts to break down. But that takes time. That doesn't just snap up and then drop right back down again, unless there's black swan events. Then all bets are off, because you can't predict a black swan event. And if you can predict that, then you should already be retired and be filthy rich right now. So that ain't happening. So what I'm saying here is I just don't see the market. I don't see crypto dropping. I just don't. And even then, when the overall markets were dropping, crypto was digesting it just fine. So it goes back to our theory. We keep saying that we've run out of sellers. I think you've run out of sellers. Why are you going to have new sellers come on? Institutions are buying. They're not selling.
True. Gosh, tell you what though, here's my final thought for the night. So we're currently at 78,000 Bitcoin, currently on day 26 of the cycle. So even if you want to say crypto is going to drop, a realistic trajectory that I could see is that maybe we just tested 78,000. We just basically tested 80,000. Maybe it cools off for a week. goes down a bit. We go up, we get a hair above 80,000, and then 60-day cycle starting to come to a close. We maybe trail off for a week or two there, and then find a low maybe somewhere in the low 70s. That could be realistic. At the same time, though, even this scenario that I'm painting for you now, it's not $40,000 Bitcoin. So, yeah, it would take a black swan event for that to happen. Clarity Act not getting passed or just like getting killed in the water somehow could be one of the ways to do that. But I mean, at this point in 2026, we've already invaded Venezuela. We've contemplated invading Iran after bombing it. I hear Cuba is getting a little antsy down there, and I don't know. Maybe we start fighting over Greenland for real or something.
Yeah, I don't know. But if
Plenty of
it
black
holds
swan events possible.
if it holds true in the kind of play out you thought of Bitcoin, it stays in its uptrend channel. It's in a channel uptrend right now. So if it stays true, it stays within that channel.
Yeah,
So,
I would love to see a nice little up cycle for the 60-day cycles when it comes to Bitcoin. I think as it stands right now, it's building to be just that. We're well above our 20-day moving average. We're well above the 50-day moving average. Maybe we get crazy and we even go touch that 200-day moving average. That'd be kind of wild. Would love to see it.
I personally like to see Bitcoin really shake people up and hit a good level. You could see it move to would be like this Fibonacci level, but it's right around just under 84,000. If it gets up to there, then the next level would be right around a psychological level, which is close to 90,000. So that would certainly scare the hell out of the bears. That's for sure.
It would. Gosh, 84. Looking at our 200-day moving average indicator is at 85,000. So it's still moving down a little bit. Might find nice confluence with that 83,000 level you mentioned, because that was some of the lows from the last kind of like section that we were trading in when we were in the mid 80s and low 90s. Yeah.
Well, I think if something the Clarity Act, something like that were to get passed, you could see it rip up to 90,000, and then you pull back to some digestion level right around that 85 level, and kind of chop sideways and start to build up some support. But yeah, the Clarity Act, that's the thing. If that thing gets passed, that day it's going to move. It's going to move pretty hard. Now, you could probably get a knee-jerk reaction afterwards, sell the news event. Yeah, you probably have something like that. But yeah, I don't know. We'll see. We'll see how it unfolds. Sure. But I think there's more risk to the upside than the down. That's what the camp I'm staying in, unless something really shakes it up the market bad.
Fair enough. I understand. I like it. Alrighty, folks, that is all we got for you this week. But do stay tuned. We have a fun event coming up this next week. It is Jerome Powell's last Federal Reserve press conference for the FOMC meetings. That's going to be on Wednesday, so keep your eye out for that one. I know over at DGen Roundtable, we're already planning for the stream after that one to be a bit of a Jerome Powell retirement party, so should be fun over there. But we'll definitely be keeping an eye on that, seeing what it is. As it stands, markets are predicting no change, so odds are I'm going to say no change. But with that being said, that is all we have for you here tonight. Thank you guys so much for stopping by. And by the way, shout out to Moonpilk Rational Optics. I see you out there, big guy. But yes, that is it for this evening. We will be back next Thursday, 9 p.m. Eastern time, as is our new streaming time. But thank you guys so much for stopping by. Keep up with everything going on. And if you want the latest and greatest for all the news, you got to get in the Telegram. So head on over to the website, get in there, and you get the best from all of us. With that being said, I hope everyone has a fantastic weekend. We'll catch you guys next week. Good night and goodbye.